This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
G'day everyone and welcome to the Simplifying Investing podcast. This week we've got a bit of a special. You've probably all heard a lot about Bitcoin, but you don't understand what it is and how it might fit in to the investment landscape. So this week I'm joined by an expert on that front. He's a guy called Jonas, and he works as a quantitative analyst within our investment team. And of course, he's done a lot of work around Bitcoin. And as you may know, AMP does have that exposure to Bitcoin, and he plays a big role in that. So welcome, Jonas.
Thanks, Shane. Thanks for having me.
Well, thanks for coming onto this podcast, but I sort of might start at the very beginning here. If you could just give us a rough idea as to what Bitcoin is.
To put it in one sentence, Bitcoin is a new form of money that is purely digital and decentralized.
So it's basically something that exists in cyberspace, and you would have, like, I guess with a bank, you'd have a security number which will give access to it. In terms of your wallet, some people say wallet, the amount of Bitcoin that you actually have. But these days you can buy Bitcoin lots of different ways. I've seen Bitcoin ATMs. I guess that gives you a digital exposure. You can go online. There's exchanges which trade in Bitcoin, and you can even get exposure to Bitcoin via ETFs, exchange traded funds.
Yeah, that's correct. Many different ways.
Let's go back to the sort of genesis of the story. How does this fit into the concept of money? You say Bitcoin's a form of money.
Yeah, and I think that's the most important question to understanding what Bitcoin actually is and what the promise behind Bitcoin is as well. Because, as I said, Bitcoin is a new form of money, or at least that's the promise of Bitcoin. So in order to understand what that is and how it fits into the money that we use today and that we've always used, we need to understand the historical context. So the first thing that I would say here is that, and a lot of people don't understand this, is that money doesn't actually have to be something that's issued by the government. This is actually only a fairly recent phenomenon, something we call currency. But historically, we've used many different forms of money, and usually it was what's called the most tradable good. And it always naturally arose in human societies as we try to find more efficient ways to trade. So humans always, in order to trade more efficiently with each other, found some kind of good that was the most tradable that they ended up using as money. So we used things like seashells, glass beads, limestones, cattle, and salt at some point even. And then eventually we converged on gold as the dominant global monetary standard that humans used for thousands of years. And the reason why we converged on gold is that it had the best monetary properties and it best fulfilled the three key functions of money, which are that it has to be a medium of exchange, meaning that it's widely accepted for payment as payment for goods and services. It's a unit of account, meaning goods and services are priced in it. And the third one, which is actually probably one of the most important ones because it actually usually comes first, is that it has to be a store of value, meaning that it retains purchasing power over time. And for gold, the reason why gold won is because of what economists call its hardness, how resistant it is to inflation. A hard money.
So that's the limited supply.
Exactly.
aspect.
So a hard money is said to be hard, not necessarily because it has physical properties that make it solid and hard
like
as
gold
a metal, but the hardness actually refers to how hard it is to inflate this monetary asset. And for gold, as you said, it's really difficult to find new gold. Then you have to mine it out of the ground, extract it out of the ground. You have to process it and actually, convert it into clean gold. And that's always naturally kept a limit on how much the annual supply of gold could grow. So that's hard money. And that was the key reason why we used gold at some point. Now, the problem with gold is that once human societies became more advanced and trade was starting to happen more globally, gold wasn't fit for that fast-paced global trading economy anymore because gold is slow to transport. It's actually also hard to divide into small subunits to use for daily transactions. How are you going to buy your coffee with gold? And then you have to melt it again and combine it into a bigger chunk for bigger transactions again. And it's also hard to verify. There wasn't really an easy way to know whether what you got was actually gold or whether it was some other metal covered in gold on the outside to make it seem like it is gold. So the verifiability, the portability, and the divisibility were a problem with gold. So what we initially did is we introduced gold-backed certificates where banks and ultimately central banks started basically holding a lot of the gold that people used to have in a central location, and then they would issue paper certificates against this gold, which were redeemable for gold.
So that's a form of gold standard.
Exactly, that's the gold standard. And with these gold-backed certificates, we actually overcame the portability issues of gold and the usability issues. So it was actually a really good thing because we overcame the limitations but maintained the hardness of that money. But with having gold centralized in a bank or a central bank, there also is some trust that comes with that, because you have to trust that the issuer actually honors redemptions and has sufficient gold to back these gold-backed certificates, which some banks didn't do. They started handing out paper certificates that weren't backed by gold, or printing more money than they actually had gold. But there was also one other issue, at least from the perspective of governments, which is that the rigid monetary supply of having something linked to gold limited governments and central banks in their ability to manage the economy and in their spending ability. And in 1971, President Nixon in the US at the time took the US, but through that effectively the world, off the gold standard, meaning from 1971 onwards, money wasn't backed by gold or any other physical commodity anymore. It was purely
backed.
There
was also a bit of a weakening in the 1930s, wasn't there, when
there definitely was.
Franklin Delano Roosevelt
exactly
devalued the US dollar against gold.
This is, I wasn't going to talk about this, but in 1933, Roosevelt actually made the private ownership of gold illegal and basically forced the US population to hand in all of their gold. And then once most of them had handed in their gold, because there were massive penalties if you didn't do it, he then created a banking holiday, devalued the dollar by 40% against gold, and basically the people that handed in their gold lost 40% of purchasing power overnight because of that action. But going back to 1971, after that point, money, which is called fiat money nowadays, is now not backed by physical commodity anymore, but backed by trust in the issuer of that money, the fiat money. But with this move, and the thing is, the move from the gold standard or using gold to gold-backed certificates to fiat money was actually one that probably needed to happen in certain ways, because it overcame the limitations of gold. Gold couldn't keep up with the global economy anymore. But because we then de-linked money from gold with the gold backing, it also lost the hardness. So you remember how we talked about how gold was hard money because it's hard to inflate. That part is now gone from money. So with that loss of hardness, we also don't have the function of storing value in fiat money anymore. So now we have a money that overcame the limitations of gold, but sacrificed the store of value property.
So what that refers to is that it's easier for your money, used to be gold, but now it's paper money or fiat paper money. It's easier for that to lose its value over time.
Exactly.
For the simple reason that the government can print more of it, which then can inflate the economy, push up prices, and so therefore $1, $100 is now worth less.
Exactly. And that is often the problem that I guess gold bugs and Bitcoiners point to. And again, it was all a trade-off basically between having the flexibility for central banks to manage the economy, but having the store of value function of money. And because the fiat money now doesn't serve as a store of value anymore, we've actually moved on to using other things like real estate, shares. A lot of people are back to using gold again as well, or art and other collectibles as stores of value because they retain purchasing power better over time.
Isn't there another argument that, yes, through the 70s, it was bad news in terms of inflation, which is basically the devaluation of the currency. But once central banks worked out there was a problem here, they then got on to inflation targeting independent central banks, which then brought that inflation problem back under control. So yes, if you look at it, you would have lost a lot of value in the 70s and into the 80s, but since then it's been a lot more stable, apart from that period in 2022.
Yeah, and I mean, that is a good point. A lot of the really bad and high inflation happened in the 70s. But even when you do the math, on 2 to 3% inflation, $1 loses roughly half of its purchasing power over 30 years. So even at 2 to 3%, if someone holds just fiat money for a long period of time, they will still see a great loss of purchasing power. And then the other thing also is that the 2 to 3% is CPI inflation. But a lot of the big ticket items that a lot of people have their biggest expenses in their lifetimes, like buying a house, going on holidays, childcare, healthcare, and other things, aren't reflected in that to the degree that a lot of people actually spend money on it. So oftentimes you find that while the basket of goods that's reflected by CPI is 2 to 3%, the basket of goods that a lot of people have in their actual lives is maybe more like 5 to 6% a lot of the time, which is why at 5 to 6%, you probably halve your purchasing power in around 20 years rather than 30.
I mean, we can get in various rabbit holes here because economists would argue the 2 to 3% was set because if you allow for quality control, like if you compare a car today to a car in the past, it's far more reliable and with a whole bunch of gizmos in there which weren't anywhere available, say, 20 years ago. And it's very hard for a statistical bureau to adjust for that. So you could argue that 2% is actually consistent with price stability, whereas if you set it at 0, you may actually be seeing deflation. The other aspect is that the ABS and the various statistical bureaus will say, yes, we know that the value of your house prices have gone up by more, but that's also wealth. That's partly why the CPI does not include house prices, or you can debate this one ad nauseum. But people do spend on things like these gadgets, and these gadgets do a lot of the things that you used to have a massive computer to do. And so in that sense, if you allow for those sorts of things, which may be considered a luxury, but everyone has them, people's quality of life is more reflective of what's going on with the CPI around the 2 to 3%, rather than saying it's 5 to 6%. Though I agree, cost of housing, cost of insurance, cost of education and health, all those things have gone up by more. But anyway, how does Bitcoin come into this? I mean, I sort of see what you're saying, and I totally agree that governments do get out of hand sometimes, and that creates problems for paper currency. And that's why we get concerned about, say, Trump taking over the Fed, or we get concerned about countries in Latin America taking over the central bank.
Yeah.
So how does Bitcoin come?
Exactly. So let's circle back to what I said before. Because fiat money arguably doesn't store value well over time anymore, we're now using other things like real estate and shares. But when you think about what those things
as hedges against inflation.
As hedges against inflation. When you think about what those things are, they are investments. They're productive assets in a way. They're not actually what most people would consider a pure store of value, so to say, because a pure store of value technically should just be an asset that you can simply hold without any costs, complexities, or risks associated with it, that retains your purchasing power. And gold or money used to fulfill that role for thousands of years. But because now we don't have the hardness of that money anymore, because it's not linked to something that is hard to inflate or resistant to inflation, we don't have that function anymore. And this is exactly where Bitcoin actually comes in. At least the core idea behind Bitcoin is to reintroduce this missing function of storing value into money anymore by creating a digital form of money, which is fit for the digital world, that kind of like gold has a limited supply, in this case, an absolutely fixed supply of 21 million Bitcoin. And
so this was set by Satoshi Nakamoto, I think. Was it back in 2008?
In 2008, he released the white paper, and then early 2009, he released the Bitcoin protocol.
So it's been around for quite some time now, but it's sort of gained a lot of focus. I mean, I sort of think it went through a phase in the 2010s where it was seen as a bit marginal. It was like the Wild West, so to speak, even into the pandemic. And then you saw various scams, and it was associated with criminal activity. And I guess was seen as the extreme speculative end of investing, whereas now it's sort of proving itself to some degree, and it's stood the test of time, even though it does have a lot of volatility. We can come on to that. But Do you think it actually? I sort of, my thinking on this has sort of evolved somewhat. I must admit, I was initially a skeptic. How could something that's existent in cyberspace be hard money? And then I've sort of come to the view that maybe it is a digital form of gold, that it is potentially fulfilling that role as a store of value. But I still struggle with the view that it's actually going to become a currency. My understanding is that it's still very expensive to transact in Bitcoin, and that cost can vary dramatically. That it's quite slow. I think Visa transaction is instantaneous. You just click and go or whatever it is, tap and pay or something, ultra quick. Whereas Bitcoin, you could be waiting up to 10 minutes because of the proof of work concept.
Yeah.
But you would probably say, well, that's maybe necessary if it's going to preserve its store of value role, that you have these protocols around it that make it difficult.
Yeah, I think you're understanding the core of it very, very well. So one other thing that you learn from studying the history of money is that every monetary good that has monetized or been chosen by the people through free market competition always...
So this is where people basically accept this is the thing we're going to accept as tender or as
where no government
trade.
Forced it on the people and said this is what you're going to use, but where people actually chose it freely themselves. What always happened is that it started off as a collectible. Once enough people collected it, it became a store of value because everybody was starting to store value in it. And only once everybody was using it as a store of value, its purchasing power basically plateaued and became stable. And then people were using it as a medium of exchange.
So that's what Bitcoin could be evolving to. Just like many years ago, decades, centuries, gold arrived at that status.
Yep.
Your proposition would be that Bitcoin might be doing the same thing.
Exactly. But that also means that right now the focus shouldn't be on the medium of exchange aspect of Bitcoin. And oftentimes people say things like, oh, but I can't buy my cup of coffee with Bitcoin yet, which...
Well, you can, but...
technically you could, and there's places where you can.
Cafes we go to.
But exactly, it's basically putting the cart in front of the horse because it first needs to become a stable store of value before it could even become a medium of exchange. And then the question is whether it even will become a medium of exchange. That's, further down the line. But I think...
But it seems that stable coins, blockchain, underneath all of this is a thing called the blockchain, which is independent of government, sits on the internet. But it seems to me that stable coins or even... cryptocurrencies like Ethereum might be closer to that. Perhaps because
you say that because of the transaction speed and those things.
Yeah, that's right. Oh. And those sorts of currencies are sort of aimed at trying to do that sort of thing. Whereas Bitcoin strikes me as something that's not aiming to do that.
Bitcoin on the base layer, on the Bitcoin blockchain itself, isn't. But people have been developing what's called layer 2 solutions, like the Lightning Network.
Yeah, but I heard about that 8 years ago now.
Yeah,
I'm still waiting for it to happen.
It's been around. No, it's around. I've got a Lightning wallet on my. I've got multiple Lightning wallets on my phone. And the beautiful thing with Lightning is that it connects in a way to the Bitcoin base layer. So, okay, I'm going to try to make this easy to understand. So basically, on the Bitcoin main layer, what you can do is you can lock away Bitcoin by sending them to a smart contract, and then you get essentially the equivalent amount of Bitcoin or Satoshis, which are the subunits of Bitcoin, on the Lightning Network. And then on the Lightning Network, you can do transactions that get settled in milliseconds, back and forth, millions, billions of transactions per second. And then every once in a while, you can settle those balances back to the Bitcoin main layer. So in a way, when you think about it, it kind of works the same way that our current financial system works, where at the very base layer of everything, there's something called Fedwire, which is the transaction layer that central banks use, where they transact money between themselves. Then on top of that, you've got a interbank layer where banks settle once a month or however frequently they do it. So when I send money from NAB to ANZ, that money doesn't actually arrive in the ANZ account straight away. NAB keeps a track of how many people are sending money to ANZ. ANZ keeps track of how many people are sending and receiving money from NAB. And then every once in a while, they settle the difference. But that just means that we've built layers on top of these interbank settlement layers, which is Visa and MasterCard as well, where you can do transactions in milliseconds. And then every once in a while, they actually settle in between banks where the money actually gets transferred. And the vision behind the Lightning Network is that something similar to that system, where you have a layered financial system, could be built on top of Bitcoin as well. Because the core Bitcoin main layer needs to be kept slow so that it remains its decentralization and security. And then you can build faster layers on top of that. But the base layer needs to be slow and secure so that it can stay decentralized.
But what about the argument, and I think you've had various attempts, various countries have looked at creating central bank digital currencies. I think the RBA in Australia was using the Ethereum blockchain as a base. And then they've sort of, none of them seem to have gone very far. And it's partly along the lines that they think there's not a lot of demand for it as a transactional currency. And I think they also worry that it will create problems with the banking system.
Yeah, I mean, that's a worry that I've heard a lot. When you look at the US, for example, they've actually specifically put in legislation to forbid a central bank digital currency, and they are now going down the road of, really supporting stablecoins like USDT and USDC. USDT is issued by Tether.
Stablecoin is a coin which is tethered, if you like, to the US dollar or the Australian dollar or what have you.
Exactly. It's backed by a real US dollar, usually a short-term treasury, actually, where what it allows people to do, and the reason why the US is able to do that is because a lot of the demand for US dollar stablecoins is coming from outside of the US. So only roughly 20% of stablecoins, US dollar stablecoins, are getting used within the US. 80% is coming from outside of the US. And why is that the case? Because people in countries with hyperinflating currencies, with capital controls, they don't want to use their local currencies. They would much rather use something that's pegged to the US dollar because it's way more stable and widely accepted in their countries as well. So they have great demand for it. But
they're usually people who, they've come from El Salvador and they go in the US and they want to send money back to their parents, but it costs a lot. And so I could see a case for like Bitcoin in that context.
Bitcoin actually gets used as a remittance network quite a bit.
Because it's better than the alternative. But if you're in Australia or somewhere, there's not a lot of Australians who've gone overseas because Australia is a hopeless country and we're not a banana republic, so to speak.
And this is another really good point. I think there's also, just because we live in a developed country here in Australia and we have a very stable banking system and everything works quite well and there's no totalitarian government that's trying to stop us from using money or hyperinflating our currency, that doesn't mean that there's not heaps of countries around the world where that's the case, and potentially billions of people that need a solution to their problem, where that potential solution could be Bitcoin. But I would argue that even people in developed countries have a use case for Bitcoin, which is it still can be a protection against currency debasement, even if it happens slower.
So it's a store of value.
Just store value.
So if you're sitting here at the moment and you're worried about excessive public debt, we talk about it in Australia. In other countries, as a share of GDP, it's 2 or 3 times what it is in Australia. France, UK, Japan, US. Bitcoin might be an option for you. If you're worried that your government is going to try and inflate their way out of a debt problem, then Bitcoin might offer a store of value.
Yeah.
You might, in times past, maybe older people like me might say, I prefer gold, I can touch and feel it. But I can imagine a lot of younger people saying, well, I'm familiar with crypto stuff or technology, so I don't have any problem with this. So this might be an alternative for me. So why don't we just look at some of the other skeptical arguments? Some people would say that this thing is just too volatile. It's multiples times more volatile than the value of the Australian dollar. It regularly has, like every 4 years, it's had an 80% pullback. So why would you want to be in this investment as an investment?
Yeah, that's a really good question. And yes, the volatility is super high. But when you think about what Bitcoin is and where it currently is in its adoption phase as well, first of all, it's an asset that trades 24/7, 365. So it will naturally be the most responsive asset to any bad news that happen, basically. If anything bad happens overnight or on the weekend when traditional markets are closed, what can investors sell?
I think we saw that when someone was dropping bombs on Iran recently. And you're thinking, well, this is Saturday night or Sunday and I can't sell shares, so maybe I'll sell Bitcoin.
Yeah, yeah. So that's the first reason. Then the second reason is that Bitcoin is still really early in its adoption phase. And a lot of people are actually still unsure about what it even is. It's only since the launch of the ETFs last year that it's become more mainstream to actually view it as an alternative store of value similar to digital gold. And even Larry Fink, the CEO of BlackRock, has come out on TV many times now and says that he now sees Bitcoin as a protection against currency debasement and geopolitical uncertainty. You've got Scott Bessent, the Treasury Secretary in the US, comparing Bitcoin to gold and saying it's a store of value. Even Ray Dalio recently came out and said that he recommends a 15% allocation to Bitcoin and gold in the portfolio as a protection against currency debasement and what he sees as a debt crisis in the US.
So it's a bit like a startup. Yeah, people can lose confidence in startups, but because they're not listed on the share market that much, but the value can go up and down. But what strikes me about Bitcoin is that it seems to be becoming more mainstream. We've seen more regulatory controls around it. It's sort of coming in from the Wild West where there was all these issues with exchanges and all those sorts of things. For some time you've been able to trade futures in it. Starting last year, we had ETFs on Bitcoin. So in that sense, it's becoming more like a mainstream investment.
Yeah, 100%. And I think all of that happening is also what triggered us within the investment team at AMP to actually seriously
This was
consider.
May last year.
Well, we started looking at it
earlier,
in January,
yeah.
And then we were writing papers, doing research, talking to stakeholders. And then I think in late April, we finally made the decision that, okay, let's maybe do this. And then it still took until, I think it was the middle of May last year that we went live with this. And again, like for us, we just saw that, there is this potential use case for Bitcoin as a protection against currency debasement, as a new digital form of a store of value. And if we see this use case for it and we don't invest in it and then miss out on a lot of potential upside, then we're also not doing our job, because at the end of the day, we are investing retirement money. So we have to be conservative and we have to make sure that we protect people's purchasing power into the future. But our responsibility also includes staying on top of new technological trends and embracing these if we think it's in our members' best interest. So we started off with a really, really small Bitcoin allocation that's dynamically managed through futures. But we've seen great returns from that. And the space has evolved in a positive way as well. So we're constantly monitoring the market. We're constantly, having trading models monitor the market to see whether we want to dial our exposure up and down.
The risk is actually managed quite closely.
Yes.
And I think the original investment was only less than 0.1%. So
yeah, 0.05% roughly.
So it wasn't big. But what do you make of the argument, and I know this came up a lot when it was announced that AMP had this exposure, that it's crazy because this asset, if you call it an asset, has no intrinsic value because it doesn't generate rents or profits or dividends, and therefore it's impossible to value it.
Yeah.
You've touched on this. I know you touched on it a bit earlier, but might as well.
Let's talk about that some more, because I think this is one of the ones that people from the traditional finance space get caught up the most, and economists get caught up on this a lot as well. And I used to have this question myself, and it took me a while.
That's because economists like to be able to value things.
Exactly.
You can use rents to value a property.
Yeah. But I think why this gets so complicated is that both Bitcoin and arguably gold as well don't fit into any of the traditional lenses that we have for valuing things.
Because it's the same with gold.
Usually it involves some kind of cash flow. But when you think about what gold and Bitcoin are, if they are mainly monetary goods and stores of value, they're actually not the typical assets that you apply those lenses to. It's kind of like saying, I don't know how to value this painting because it doesn't generate any dividend yield. It's the wrong tool for the job, essentially. And what's very fascinating about that is that when you then think about it, that probably means that there is something that humans inherently value that isn't directly tied to some kind of cash flow generation or industrial use case even, but it's just something that maybe for a monetary good, we value the monetary properties of that good and how superior those properties are compared to other monetary goods. And that we can give something value just because it has the properties that we want something to have. And one of the key ones is scarcity. I mean, humans value scarcity everywhere. Like there's people buying Pokemon cards for hundreds of thousands of dollars or paintings for millions or hundreds of millions.
They can come and go in terms of being fashionable. It's like Labubu dolls at present. I can think back through time, Cabbage Patch Dolls, and there's a history of these things. But they come and go.
Because they're attached to cultural trends. But with something like a monetary system or monetary network, it's just money. Money doesn't really come and go. It only, if we have something that has better monetary properties, and if it's so much better that it will overcome the network effects and the path dependency of the previous form of money that was the dominant one, only then will it get replaced by something new. And with gold, it's been the dominant one for thousands of years because it had by far the best monetary properties of all the physical goods that we had. And it had a lot of path dependency and network effects and social consensus. But that also means that in the physical world, it basically wasn't really possible to find anything that could have replaced gold because all of the limitations of gold are tied to its physical existence. So anything else that's physical would have had the same limitations. So when you really think about it, the only thing that has a potential to replace gold as a dominant monetary non-sovereign asset is something that's not physical in form, because only something that is immaterial can replace something or overcome the limitations of something that is material, which potentially could be Bitcoin.
Fair enough. What about the argument, you don't hear this one as much, that it uses too much electricity?
Well, that really depends on...
It's the mining activity. So there's a limit of 21 million Bitcoins out there. My understanding is that that'll be reached by, 2040?
2140.
2140. And if it was going to be, 2140.
Yes.
So we've still got a way to go on that basis.
Yes, we've got 115 years to go.
Yeah, but the process of mining means that you get less and less each time. It halves, doesn't it? Is it every 4 years?
Yeah.
So it halves. That's why it slows down. But anyway, you've got this limited supply out there. But basically using computers to solve a mathematical problem to generate the extra Bitcoin. So it's the computing power which is generating the extra electricity.
Exactly. And the Bitcoin uses a lot of electricity. There's no doubt about that. It uses roughly 0.5% of global electricity demand, similar to countries like Sweden. Sweden is a small country, but still, it's a lot of electricity. But then the two questions that you have to ask yourself is, first of all, where does it get that electricity from? How much of that is renewable? And the second thing is, what is that electricity being used for? Because if it's something that if people don't understand the value behind Bitcoin, they will see it as waste. But if people understand that maybe there is a lot of value in having a decentralized monetary system that basically brings an egalitarian monetary system that no one controls to the whole world and even to the unbanked and people in developing countries, maybe it is worth using electricity for that so that they have something where they can protect the fruits of their labor so it doesn't get appropriated from them, from their governments.
Yeah.
And then coming to where does the electricity come from? When you actually look into what share of Bitcoin mining comes from renewables, that's somewhere between 54 to 60% at the moment. And compare that.
So it's an ideal use for, we generate a lot of wind and solar during the day, whereas it's not necessarily, and some of that electricity, even in Australia, goes to waste. It's not used. That's why there's issues now with households generating so much on their roof, and then it goes into the system, but we can't use it and creates all sorts of problems.
And
you could argue this could be a use for it.
And that's exactly where a lot of Bitcoin mining is coming in at the moment. So Bitcoin mining is a super competitive industry, which also means that miners constantly chase the cheapest electricity they can find, which usually ends up being stranded or excess renewable electricity. So electricity that doesn't get used at that time, which is why Bitcoin mining uses close to 60% renewables, because they just find renewable grids where there's overproduction or where there's just too much electricity in general, and they can just tap into that. So a lot of that is actually coming from renewables. But when you look deeper into it, Bitcoin mining can actually be used to help subsidize new renewable projects as well, because you will always have a buyer of last resort. So you can build renewable projects that maybe wouldn't be profitable otherwise and just plug Bitcoin mining into it. And they can always take on the excess electricity that you're producing during peak hours. And then they can also dial down when a population needs the electricity. So because Bitcoin mining can be dialed up and down in seconds, unlike AI powered data centers or aluminium smelting, which is another one where they're doing similar things. You can't just shut that off very quickly. But Bitcoin mining, you can ramp up and down in seconds without it causing any harm.
Just quickly before we run out of time and move on to the role of Bitcoin in a portfolio, what about the argument that people associate it with criminal activity?
Yeah,
if you get these scams, that phishing exercises come in and they're trying to catch people doing something or other and make you feel guilty and then put some money into a Bitcoin account.
Yeah. That is something that people have been saying for a long time. And to a degree, Bitcoin is used for criminal activity, just like every form of money is. But when you look at the statistics, fiat money, roughly 2 to 5% of transactions in fiat money are linked to criminal activity. For Bitcoin, it's close to 0.1%, or based on the most recent data. And the reason for that actually is that because Bitcoin is an immutable public ledger, transactions will be visible and stored on the blockchain into eternity. So while there is some anonymity within the blockchain ecosystem, as soon as you try to use the on and off ramps of that, and you try to convert your Bitcoin to fiat money, or a criminal tries to do that, at that point is when they get caught. And it happens all the time where criminals who hacked somewhere 10 years ago or something like that are finally converting their Bitcoin into money, and then the police catches them right there and there. So criminals who know what they're doing would actually be ill-advised to use Bitcoin because it's more traceable than just using cash.
Yeah. And just finally, to wrap up on all, how does it fit into a portfolio? I guess one of my concerns is that often, because I track markets quite closely, and I look at Bitcoin every day, that oftentimes when you get big falls in markets, like say shares, those falls that we saw earlier this year around Trump's tariffs in the US into Liberation Day, the US share market fell something like 19%. I think we in Australia fell 14%. This is from the February high, whereas Bitcoin fell something like 30%. And then when we go back out the other way, shares go up and Bitcoin goes up by more. So you're ending up with an asset which could actually be high, what you call high beta relative to the share market. So how would you put it into a portfolio then?
So the way that I think about Bitcoin in a portfolio is that you're right. During specific times, it actually the correlation converges on one. Like they become more and more correlated, especially
that's
during
like
times.
Growth assets generally.
Exactly, which happens to most growth assets in a portfolio.
Even at the time of the GFC, back to your point about selling things that you can, it wasn't necessarily on the weekend, but at the time of the GFC, gold initially went down because fund managers, investors were trying to sell their winning trades. And so even though it wasn't a problem at the time, and ultimately did quite well out of GFC, but initially it was sold down.
Yeah. But when you actually zoom out and look at the long-term correlation structure between Bitcoin and equities or bonds as well, over the long run, it's actually fairly uncorrelated. It's actually on average close to 0 or 0.1. So yes, sometimes you'll have periods of time where it's highly correlated, but over the long run, it's actually a really good diversifier for a portfolio because it is so uncorrelated. Now, the thing that we need to say about that is Bitcoin still comes with a lot of volatility and a lot of risk. So if you want to put it in a portfolio, it should be at a very small allocation. But the good thing about Bitcoin also is it's been the best performing asset 10 out of the last 14 years with.
But it was a startup.
With amazing returns.
Yeah.
But I would argue that potentially, at least based on the adoption trajectory, we're still at a very, very early stage with Bitcoin. We've already seen high prices, but I think we're still quite early.
But let's say you buy that, and I must admit, I've sort of come to this view that it is a form of digital gold. You still got to allow that somewhere out there might be another 80% drawdown at some point.
And that's why you do a small allocation, because the good thing about Bitcoin is because it is so uncorrelated. When you add a small allocation to a diversified portfolio, I've actually run the back tests on this, so I know the numbers. The volatility basically gets diversified away because you have a broad diversified portfolio, and we're talking like 1, 2, 3% allocations to Bitcoin here. But because it's so uncorrelated, volatility gets diversified away, and all that you're left with, in a backtest at least, is the excess return. And even at a small allocation, because Bitcoin's returns have been so good, it actually adds quite a bit of return to the portfolio. So, and this is what Larry Fink from BlackRock says as well, and BlackRock recommends roughly 2 to 5% allocation to Bitcoin, is if you want to put it in a portfolio, start small and get familiar with this asset, try to understand it better, monitor the market, and then maybe if volatility keeps decreasing over time as adoption increases and everything keeps developing positively, then you can ramp up exposure. But I don't think anybody should be jumping into Bitcoin with a big allocation, not institutional investors, not people.
I think the good thing now is that if you want to get into Bitcoin, you don't necessarily have to buy Bitcoin directly. There are other alternatives, just like there are with shares. You can use futures or ETFs.
Yep.
Anyway, I think this has been a great discussion, Jonas. I hope everyone's found this of value. And until next time, see you then.
Thank you, Shane.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.